production. The theme for this month is something that I gathered last week. I had the opportunity to talk to top management from 7 of the big Bakken operator companies, 1 worldwide service company, and 3 pipeline companies. And I heard this over and over during the week, and it was called lower for longer. So I think we're going to see that in the numbers. The attitude of the industry is that prices are significantly lower than anybody expected a year or even 6 months ago, and that they anticipate them staying lower much longer than was expected a year or 6 months ago, meaning that these kind of prices are now getting built into operator plans for the first 6 to 9 months of this year, and maybe even all the way through 2016, as they try to figure out what are they going to be able to do in 2017. So let's kind of run through the numbers. Production down 2.5% at 1.15 million. That's a very significant drop, and I think what we're seeing is the first real production decline. We've seen a lot of noise in the production over the last few months, but now we're seeing the effect of lower rig counts, lower completion numbers, wells being put on inactive status, continued wells going into NC status. And so we're seeing actual production declines begin to kick in. And I think that's very important. Some of the noise that we saw in the earlier months had to do with concerns about flaring restrictions and people choking wells back in order to achieve the gas capture goals, and then opening wells up. Oil conditioning with the seasonality and the really cold temperatures and that sort of thing. But this looks like it's a real number based on real activity. Gas did not decline quite as much. It was down 0.3% at 1.67 BCF a day. That again is the flight to the core where the gas oil ratios are higher. So oil production fell a lot more than gas production did. On the permitting side, down significantly. The last time we saw numbers like this was in August of 2009, and we permitted 40 wells that month. So it's been almost 7 years since we've seen numbers that low in the permitting category. The prices speak for themselves. $16.50 today for North Dakota Sweet. We haven't seen prices that low since February of 2002, which goes back to the 1999 through 2003 price slump that we saw the last time that the markets believed that the world had gobs of surplus oil. One of the things that's coming, and one of the reasons that companies are saying lower for longer, is something called debt redetermination. And that really kind of hits in June. So what we've seen is the first thing that hit was when the SEC required reserve reevaluation. A year ago, companies evaluated their reserve picture at $90 oil. This fall, in the fourth quarter, the SEC said reevaluate at $50 oil. You can see what's going to happen if prices stay where they are. Now, as we move forward with that, and you look at the current price, West Texas being at about $30, the banks and the lending institutions are going to be looking at something called redetermination of debt, and so we still anticipate that we're going to see bankruptcies and financial problems for some of our smaller, more leveraged Bakken operators. Those haven't really come as quickly as we thought, and I kind of got the answer to that as I was talking to people last week. It's all about when they have to do their redetermination of debt. Today's rig count, it was 41 when I started the day, and it's 40 now. When we look out into the future and talking to our 7 big operators, at these prices, by the middle of the year, that looks more like 29 or 30. So unless the price picture changes significantly, there's another 10 or 11 rigs that could be released from operations. You can see the percentage decline in rig count. A couple of other things I want to mention. We still have 697 wells that are being transferred from operator to operator. So there is still midterm and long-term optimism on the part of the venture capitalists and the hedge funds. They're still buying North Dakota producing properties. They think this is a fantastic purchase opportunity, and they're able to buy things at a third to a fifth of what they would have paid just a couple of years ago. So there's still that kind of midterm to long-term optimism. One of the numbers that I talked about yesterday with the commission I want to talk about is we're up to 1,183 inactive wells. That's 365 above normal for this time of year. So we are seeing a lot of financial stress on low rate producing wells. These are not the wells that have been drilled but not completed. I think we're at 945 in that category. So that has stayed pretty steady at close to 1,000, but we've seen the inactive wells jump well over 1,000, and I expect that number to keep going up. We talked yesterday about a policy, or the policy of the commission, to grant waivers to the requirement to TA or plug those wells. And so I think you'll be seeing a lot of activity. In fact, the phone's been ringing pretty good this morning with operators of marginal wells inquiring about how all that's going to work. What we're talking about there is typically wells that make less than 15 barrels of oil a day. Or in the case of the deep horizontal wells, if they make less than 35 barrels of oil a day, they go into that marginal well category. And those wells will probably not be repaired if there's a mechanical failure or some kind of a problem with the well, especially in the wintertime. It's not going to be economic to hire a workover rig and go out and put the well back on production. So that's the kind of wells we're talking about. And we're already 365 above normal. So in terms of op costs and that sort of thing, lower for longer. Already talked about the 945 wells waiting on completion. Gas flaring down only slightly, down 1%. Flared volume down just under 17 million a day. And in the federal rule category, a couple of new things. One is that the BLM has now released their final proposed rule on venting and flaring. And there's going to be I guess what you call an outreach session. That's in Dickinson on March 3rd. We intend to attend and comment, and y'all may want to be there. And then comments are due April 7th on the rule. And depending on the Q&A, we might get into some of the differences between this rule and our rule. And then finally, U.S. Fish and Wildlife came out with a new rule. Comments were already due February 9th. That has to do with non-federal oil and gas wells that drill under a U.S. Fish and Wildlife easement or a wildlife management area or a waterfowl production area. And as you know, North Dakota has an enormous amount of what we call prairie potholes, and almost all of those have fish and wildlife easements on them. So it's a rule that has widespread impacts, especially for northern Williams, all of Divide, almost all of Burke County, McHenry, Ward, Renville, Bottineau would be impacted very heavily by this rule. And we're most concerned about Alternative C, which they didn't choose, but there are some things in Alternative B that aren't good for North Dakota's regulation of oil and gas as well. So we've submitted comments, and we'll just have to see what happens there. That's a run through of the numbers and the activity. The theme for us and for our operators and our service companies and our pipeline companies is lower for longer. And that's kind of pessimistic. But there is midterm and long-term optimism.
Okay. The first two questions from the webinar are in regards to the break-even numbers. So maybe just any highlights from the break-even numbers, and then we can get into the specifics on that.
We try to do these once a quarter, and we redid the break-even numbers. Not a lot changed. I think it's interesting to see that there's only 2 counties that at current price, and what I'm calling current price is 15% below West Texas Intermediate. I'm calling that the North Dakota price. There are 2 counties that are economic to drill in countywide, McLean and Dunn. There are some others that are close, and so if you look at McKenzie County, if you look at Williams County, there's some small portions of those, McKenzie County in the northeast and Williams in the southeast, where it's economic to drill. But again, it speaks to our anticipation and the conversation with operators that at 40 rigs, there's another 10 or 11 that will be released if the prices stay as low as they are.
Anything that you can attribute to the drops in Dunn and McKenzie County, in those counties specifically?
Yeah, a better well performance. One of the things that we talked about and that I talked with the service company about is some really interesting technology, and it's going to get presented at the Wilson Basin Conference. Please come to that in May. We're really looking forward to it. There is some refrac technology that is on the street now and being implemented, and then in conjunction with that, we call them super fracs. One company has actually pumped a frac next to a refrac with 20 million pounds of sand, and they're really excited about the results. So we're now seeing the average be pretty close to 10 million pounds of sand and over 8 million gallons of water. So the frac volumes have gone way up, and the well performance has gone up with it. Another technology that I was surprised as many companies were interested in it as is gas lift. We're going to have a presentation on using that as a different form of artificial lift for wells, and big improvement in productivity and decline for the wells.
Okay, this kind of plays off of that actual theme. New technologies, is it that give them any room to lower their break-even costs, or have they squeezed all the efficiencies out that they can?
Actually not, and that was kind of a surprise that the operators, and particularly the service company, still think that there are some efficiencies to be had. One operator in particular is thinking that we really should be using 100 stages in a Bakken frac instead of the average 40. And so they've been experimenting with that. Also, that the well placement can actually be reduced down to 500 foot between wells, which will increase the overall recovery of Bakken oil. One of the service companies, the one that I talked to, they're going through a merger. They're working with the federal government to approve this merger. But if these 2 large service companies are able to merge, they think that they can generate a couple $2 billion per year in terms of procurement savings, and they can pass that on to the companies, which potentially could reduce the cost of a Bakken Three Forks well another 10%. So kind of quite a bit of excitement around technology. People are not sitting still, and they're still planning to invest their money in the enhanced oil recovery tests this year, even with the lower prices, trying to position themselves to have enough capital that in 2017, with better oil prices, they can get back to work.
Anything from the conference room? Because I got plenty on the webinar.
Okay. The companies that you talked to give you any indication about layoffs or what we might see going forward with layoffs?
Yeah, the question was, these operators and service companies, did they talk much about layoffs? It's a very mixed bag. Some of them have already been through a couple of rounds of staff reductions, and then about half of them are just getting started on that. But in terms of contractors, drilling and hydraulic fracturing crews, they've pretty much done all of that, but they all are planning some personnel reductions in the first half of this year. So they're all saying that the first 6 months of this year, there's going to be quite a few pink slips. I'll give you a couple examples. We did something. I did something unusual. I used Uber. I was in a big city, and so I used Uber, and 3 of my Uber drivers were laid off oil and gas employees. So that gives you some idea of what's been happening in the industry. So.
Okay, the magic question everybody wants to know. Given prices and well counts, when will production likely fall below 1 million barrels a day?
We still have production exiting at 2016 right at 1 million barrels a day and falling below that in early 17. Given prices and drilling and that sort of thing, if things don't really change, we're down to 900,000 barrels a day by year-end 2017. So early 17.
And we have some slides on our website. I can also provide them if you guys would like. That just kind of gives some forecast scenarios at different price points that we've been using in presentations. So if you'd like that, I can certainly send that along. Just let me know. But it is on our website, but I can certainly get it to you guys. Okay. Obviously, there was news out of Russia and Saudi Arabia about agreeing to freeze production. WTI is up a little bit. With these factors, can we expect a price climb?
The speculation is that that has just halted the price decline. That in fact what we're seeing now is some of the big players, Russia, Saudi Arabia, and Iran, working together to stop the decline in prices, but that any kind of significant improvement in prices is still 9 months away. That's based on the fact that we have more oil sitting in storage tanks in the United States than we've had since I think it's 1935 or 36, and the rest of the world looks the same. Interestingly enough, I didn't have time. Someone offered to take me on a drive down to Netherlands and down along the Gulf to look at, but they're still building storage tanks down there along the Gulf of Mexico. So there's a place called Netherlands, Texas, where a lot of pipelines end. And so we continue to build inventories. And of course, we're going into spring, which is traditionally a low oil consumption time. So the actions of the 3 big price war countries really is just all about halting the price decline. It really isn't about improving prices. And most folks think that's still 9-10 months away.
Okay, always questions about how we come up with our prices. Why the wide difference between Flint Hills and then the adjusted WTI?
There is no posted Bakken price. We don't have a Bakken crude with a posting, and we have the transportation differential or basis, as you would say, for North Dakota Bakken crude. The closest that you can get is an arithmetic average of WTI and Flint Hills. Flint Hills, of course, purchases a large volume of heavy sour crude out of Canada, and so it is significantly lower than Bakken wellhead price. WTI is significantly higher because it's Cushing, Oklahoma, and we're hundreds of miles from there. So there's several different ways of trying to get at the price that North Dakota producers are actually receiving. One way is to use 85% of WTI. That gets you close. I've actually found that if you want to be within $1, the arithmetic average of North Dakota sweet and WTI gets you within $1 on any given day. So I wish there was a posted price for BKN, but that hasn't happened.
I've got another price question, but I'm going to have to get a little clarity before I ask it. So let's move on to the easement rule, the federal easement rule that would impact Northern Williams, Divide, and Burke. Can you expand just a little bit on that and what kind of impacts that would have?
Yes. The concerns about the U.S. Fish and Wildlife Service rule on easements is that they're proposing to require bonding for any well that would be drilled near a refuge or an easement and drill under the easement or refuge. So the impact would be now any operator who was going to drill a horizontal well under an easement would have to post a bond with the Industrial Commission, post a bond with the Bureau of Land Management, and post a third bond with U.S. Fish and Wildlife. And then they're also planning to codify a lot of policies and things that they have on reclamation into actual rules and begin a process much like what the Forest Service does for permitting a surface use permit for any well that drills under fish and wildlife easement. So there's kind of a multitude of effects, one being financial, that there's a whole other bond and bonding mechanism required. That'll take time and money. A whole other permitting process required. That will take time and money. And then finally, these policies on paint colors and siting of wells to minimize visual impact and wildlife impact, that'll take time and a little money.
Go ahead.
Yeah, just on the bankruptcies you mentioned, last director's cut, you said you were expecting another company to file the following week. Has that happened? And can you talk about why the bankruptcies maybe aren't going to happen as soon as you had initially thought?
Yeah, the question was about the bankruptcies, and you're right. A month ago, I was anticipating another bankruptcy the week following, and I was actually expecting one this week after talking with operators. But I started asking some questions about why it's going much slower, and the answer was that the debt redetermination time frame is actually in June. So I was thinking it was around year end, and that the call on people's loans and the reevaluation of their assets by their lenders would be happening around the end of the calendar year. It actually happens on a fiscal year basis, and it won't be happening until June. So there's a good chance that some of these companies will hang on for a few more weeks or a few more months, and it's also possible, if prices improve, that they won't end up in the bankruptcy court. But it's all about the timing of debt redetermination.
You haven't seen those other two?
We have not. There is still a list sort of in my head of 4 or 5, and some closer than others. So I think we've seen a couple, and at these prices, there's more to come.
So you said 4 to 5. Do you have a number that maybe you're thinking that might top out on, and if that would have an impact on production?
Yeah, the total number is probably in the 5 or 6 range. We've had 2, so that makes it 6 or 7. One of the conversations I had, and this individual with KLR, they're a financial analysis company. He's going to come to the conference in May as well. He'll be worth coming and listening to. he made a comment. He said the Bakken is a world-class oil play and it needs to be capitalized like it was a world-class oil play. It hasn't been yet. So we still have 22 Bakken operators, essentially. And if it's properly capitalized, he expects that to aggregate down to a half a dozen. So that means that, 22 operators, some of them fairly small, end up being aggregated into 6 or 7 large operators or companies. So I think that's what's coming, is as people go through debt redetermination, we're going to see a lot more wells in transfer, and we'll see companies that are in financial distress be aggregated by some of the larger companies. And there were some really big companies came by the North Dakota booth at the NAPE Expo that were looking and talking.
So do you think that those numbers would have an effect on production, or is it just kind of a transfer of assets?
Yeah, I don't think that is really going to affect production. I think it's going to be a transfer and just a different operator. I mean, there may be a short-term effect, but typically, when you look at, for example, Oxy selling 350 wells to Lime Rock, there wasn't any change in production. It was just a new operator coming in with a different way of running things.
Okay, any questions here?
Do you have any concerns about the hedge funds or the companies that are not oil companies that are acquiring these wells? Any concerns about their ability to follow the rules and regulations?
That's actually a question that was just on here. I was trying to make it fit. So
that's a good question.
Yeah.
The question was about some of the aggregators or the companies that are purchasing assets, and it is a big concern. We started a process, and we started it almost 2 years ago, of doing background checks on people who are acquiring assets or getting a bond in North Dakota. And we don't just look at the company, but we also get a list of their officers and directors and look a little bit into them as individuals. Probably of more concern to us, and you saw it maybe in the rules that were proposed yesterday, is some of the spin-off by operators of some of their midstream sort of assets, like saltwater handling systems, to a hedge fund or a non-operator. And so we're looking at a mechanism to require bonding and more oversight of those kind of operations, because they're not oil and gas operators, and they're more midstream-like, but they're handling something that can be a really big problem. One of the things that came to light in talking with operators was their number one cost is water handling. There's a lot of water to be moved and disposed of in the Bakken, and that's their number one cost. So they were super excited about the work the Geologic Survey is doing, mapping our disposal zone, and the work that EERC is going to be doing to computer simulate capacity for the disposal zone. That got a lot of interest on the part of operators, because their number one operating cost, the best place where they can cut.
Backlog of inactive wells. How will this affect price recovery?
Well, I'm not sure about how it affects price recovery, but let me just say that the conversation about the inactive wells is that their break-even price point is $35 to $45 a barrel. So when you're looking at prices where they are today, they're well below that. And so that's why I say I think that 1,183 inactive wells is going to grow substantially, and we're not going to see that peak and turn around until we see North Dakota prices in the $40 range, which is 6-9 months away.
Okay, do you want to talk about the, we've got just a couple minutes left here. Do you want to talk about the federal flaring rules? You had mentioned that they differ in a way from North Dakota's rules. So do you want to talk about how that would impact North Dakota?
Yes. when the BLM designed this proposed rule, they did a lot of shopping and tire kicking, and they looked at North Dakota's new rules, they looked at Wyoming, they looked at Utah, and it appears that they kind of chose the strictest from everything and put it all together by committee into one rule. That creates some conflicts. There's some really good things in this. For example, a gas waste prevention plan, or as we call them, gas capture plans. That's a new requirement in the rule. Every APD is going to have one, and we think that's a great thing. But at the same time, they imposed a hard number, 60 MCF a day per well maximum flaring. Well, that fits pretty well with our ultimate goal of 95% capture or 93% capture, because it represents 6% of the produced gas when a well is brand new. What it doesn't take into account is the way unconventional wells act over time. And so in year 5, it represents 100% of the gas production from a well, because Bakken wells decline from 1,000 barrels a day the first week down to 55 barrels a day by year 5. So that 60 MCF a day is 6% of the gas when the well's brand new, and 100% when it's only 5 years old. We think that's something that needs to be changed. Otherwise, a 5-year-old well could just be bumped off the gathering system with no consequences whatsoever. It could flare 100% of its gas, and that space would be taken up by new wells. That's not a very workable rule, and it was built on conventional gas wells in Utah and Wyoming. Probably needs to be changed. That's one of the most significant differences and would cause probably the most interference between North Dakota's rules and regulations on flaring and the BLM rule. And then there are some others, maybe less significant. One of the other concerns has to do with leak detection. They're locking down current technology on how to detect methane leaks. They're saying you got to buy a FLIR camera, and that's the way to go. And then they're saying that if you find a leak, you've got 15 days to repair it, and then 15 days to retest. Well, we all know what the weather typically is in February in North Dakota, and climbing up on tanks and repairing leaks in a 15-day time frame might not be a very good idea. So we're suggesting that they come up with a little flexibility there that takes into account what the weather's normally like in January and February in North Dakota.
Okay, last question. I think it's a real quick answer. What's the magic WTI price to keep Bakken production above 1 million barrels a day?
The magic price to keep Bakken production above 1 million barrels a day is between $40 and $50 a barrel. It's that $45 price. That stimulates enough drilling and enough completions that we don't see the price decline.
Okay. That's all for now, folks.
I think Emily had one.
Oh, I'm sorry.
No.
I was just wondering, like, everyone's asking about 1 million barrels a day.
Yeah.
Do you care? I mean, what is the ideal production from your perspective for North Dakota at these oil prices?
Sure. There's a great question. Do we care about 1 million barrels a day? And there really is not really. I mean, it's a significant marker, but that's not really what we're about. We're about regulating and helping. We care from the standpoint that we have to help the legislature figure out what the revenues are going to look like next biennium. We care from the standpoint that the further we drop below the 1.2 million barrels a day, the lower the peak will likely be, below 2 million barrels a day. So, for example, if we drop below 1 million barrels a day, we may never be able to get to 2 million barrels a day. We'll get to 1.8. But in terms of caring only from the standpoint of projecting revenues for the state, it's not a goal to keep it above 1 million or anything like that.
Good clarification. All right.
Time for one more, maybe?
No, sorry.
Okay.
Because then it's one more, but.
Oh, bicycle.
Then it'll be like my husband and just one more Morgan Coke, hon. One more. No, we're going home.
You get pictures with this one.
Yes. I don't know where I'd be without charts. So. It'd be pretty dull to listen to, that's for sure. Okay, well, good afternoon, everyone. I'm Justin Kringstad, Director of the North Dakota Pipeline Authority. Pretty standard set of slides to walk through today on the transportation side. Taking a look at what's taking place in the other neighboring states in the basin for oil production and transportation. Minor slides in both eastern Montana as well as South Dakota. You can see they're a month behind in their reporting, but we are starting to see that decline in neighboring states as well. On the transportation breakdown out of the Williston Basin, percentages really haven't changed all that much from the time we met a month ago. However, the production has gone down, and so that has impacted overall volumes, as you'll see in some of the coming slides on my estimates for how much is actually physically being moved, say, by rail and pipeline. So historically, again, WTI price staying relatively close to the Brent price, and so with that tight spread conditions, likely, again, we're going to continue to see the pipelines be utilized as much as possible, and then any barrels that are committed to the rail lines will continue to use that transportation system. So slide 5, then, just looking at my estimates for rail volumes again, continued decrease, not only in the market conditions, but like we said, with the decreasing production overall. This is a likely outcome of that as well. Slide 6, just another monthly update. Nothing really has changed with where those barrels that are headed, that are leaving by rail car, continuing to head primarily to the East Coast and then followed up by PADD 5, which is the Pacific Northwest of the U.S. Pricing from November, again, not a big surprise. You look at the previous chart matching up pretty closely with this one for where those barrels are headed. That East Coast having the highest priced market in November, followed by PADD 5, the West Coast, and then the Gulf Coast. So again, you can start to think along the same lines as someone that has a barrel of oil in North Dakota, where you want to move it to and what its value is at those different destinations. And then where we sit today, last couple weeks or so, we've been trending around a $2 to $3 spread between Brent and WTI. A couple months ago, with the export ban being lifted, I would have thought that it would have stayed more on par, but we'll see if this is a continued trend or if this is just a blip in the market conditions. But I'm not expecting, again, some of those large price spreads that we had seen in the 2011-2012 timeframe. As far as the import-exports across the border with Canada, continuing to see more barrels coming into North Dakota than are being moved by truck into Canada. Again, I don't have any clarity as far as exactly where these barrels are headed to, if they're headed to rail facilities, if they're headed to pipelines, if they're marketed with other Bakken barrels. Exactly what's happening, that stays proprietary to the folks that are doing those transactions. So I don't have any other clarity other than just the volumes themselves at this time. Flaring, as Lynn had mentioned, down 1%. Same with the non-confidential data, and where we saw that decrease was in the amount of gas being flared from the zero sales wells. That blue piece of the pie shrunk down 1%. So again, wells are continuing to get connected. We've got data to support that on slide 11. They're still outpacing the drilling activity, and with the expectations that drilling activity is going to slow down even further, I don't have any concerns that the gathering systems won't be able to keep up with getting wells connected. A couple of the other gas developments that have happened in recent months. In December, we saw the One Oak Lonesome Creek facility go online. So that was a 200 million cubic feet per day facility that started up at the end of 2015. So we'll likely feel the full effect of that January, February, when those production numbers start to come out, when we start seeing that impact on flaring in those months. With that, the only other development I will mention, this came out late yesterday afternoon after the markets closed, I believe. The Sandpiper pipeline system there was an announcement by Enbridge that they are now targeting 2019 for an in-service timeframe for that pipeline system. Originally, they were targeting 2017 to put that system in service because of continued timeline. It was extended beyond their expectations in Minnesota. So the updated timeline is now early 2019 before that system is expected to go into service. Again, all subject to that regulatory process in Minnesota. Just for refresher, that's a 225,000 barrel a day pipeline system that would originate in North Dakota and move barrels to a hub at the Superior, Duluth area in Minnesota, Wisconsin. So with that, the other development I'll quickly add, the Dakota Access Pipeline. There was further meetings by the Iowa Utility Board that took place early in February. They're meeting again. That no decision was made at that time. Iowa is the only remaining state along that Dakota Access Pipeline that has yet to make a decision on that system. They are meeting again Friday this week, but no word as to whether or not to expect a decision at that time. So with that, I'd be glad to answer any questions.
Okay, first question from the webinar. Actually, they want to go back a month. The November crude by rail numbers showed a drop from October, but EIA data showed a significant increase that month from PAD 2. Can you help us understand this discrepancy?
Right, so my numbers being estimates, the EIA, I believe some of their nearer term months are estimates as well, and so I think it's going to take some time for the EIA, some of the data that they use and some of the production numbers that come in for North Dakota and Montana. We'll see how it shakes out, but it doesn't surprise me that there's some discrepancies in these near-term months, and there's a lot of difficulty and a lot of moving parts to try and come up with these estimates for those rail numbers.
Amy?
On the rail terminals, the amount that's being carried by rail has decreased, plus there's been a couple new rail terminals that have opened. Are some of these rail terminals having to close, or are you hearing where that oil is moving with their additional 2 facilities that came online recently?
So the question was on the rail facilities themselves, kind of what their outlook is with some new facilities. I don't have any clarity on each individual operator of those facilities, what their intentions are long term. I would suspect, though, that we're going to continue to see some consolidation to some of the larger facilities that are connected by pipeline, both in and out. So barrels that are able to be gathered into that system, that rail facility. Market optionality if they're connected to another export pipeline potentially, that they use that rail facility as a hub for marketing purposes. So we're going to continue to probably see some more consolidation. Some of the other facilities, I don't know, long term what their game plan is, and I think time will tell how that shakes out.
So what would you say the biggest factor is in the decreasing percentage and volume of Bakken crude oil leaving the state by rail?
So the question was, what's the primary reason behind the decreasing crude by rail in North Dakota? I would say leading up to December, it was market conditions, and then in December, market conditions coupled with decreasing production levels. So again, that spread between the Brent, those coastal oil prices, and then the mid-continent WTI price would be the major driver.
Is there any expectation on the Sandpiper delay impacting transport out of North Dakota? Will crude by rail pop up a little bit longer than expected?
That's a good question. That's something that since that announcement yesterday, I've been trying to figure out how to best look at that. So that system, if it would have gone into service in 2017, would have had the capabilities to move 225,000 barrels of oil per day by pipeline to the Great Lakes refining complex. With that system being delayed 2 more years, those barrels will have to find an alternative. And so it's tough to speak in generalities, because for the shippers that were planning to utilize the Sandpiper pipeline during that 2-year period, those are the folks that are impacted the most. They've already got deals set up, contracts set up to market that crude oil, and refineries that are expecting deliveries of that crude oil. And so those are the type of market conditions and things that are going to have to work themselves out with that delay. Those barrels will have to be shuffled around. we're going to have to see, again, how that transportation dynamic changes during that period of time.
Going once? Going twice? Sold?
Okay, thank you
Okay.
very much.
Thanks.
And what city were you in?